geek of the options equations. If you go to the algorithmic part, or if you like focusing on quant based building and options based strategies, you need to know about these components, where which is going to be measured by mathematical equation. You're just going to measure the price or anything inside the options with these kind of mathematical equations. So let's go little deeper. First one is delta. So delta is nothing but it's going to measure the value of an asset, like underlying asset, with the strike price. So with this, what you can do exactly is you can build an advanced level edging based strategy, or for knowing what is the base level happening when the price change, when the current price change, what is happening on the strike price. So for noting down this, delta is very very important. For example, if $1 has been moved in a current price, if you want to know how much it can move on the strike price, on the each strike price, for calculating that, delta is very very important. So delta is used to calculate the strike price value within current price value. So if you want to make it even more understanding. So, but the thing is, you can use this delta in a lot of places, not only in options, even you can use this equation in lot and lot of places. And next one is gamma. What is a gamma? See, gamma is like not only here, even whatever the strategy we build, we will use this. So gamma is very very simple. It's going to find out what is the rate of change between the delta, to find out how much risk is there with our portfolio. So for example, if you are going to find out how much risk your portfolio is holding based on the current price and based on the the delta and the current price value, you can use this gamma and you can build a strategy which is combined to find out the risk which your portfolio hold, like which your strike price is holding. So it's going to find out the rate of change in the delta. So with that, you can come to the conclusion, okay, this much it can be go, or this much it can change. With additional equations you can build it, or normally you can find out, okay, this much change it can happen. So this called as the gamma. And next one is theta. What is a theta? Theta is nothing but the time decay. For example, if you are buying a contract, there is something called expiry. If you are holding till the expiry, your money will get drained, it will burn in front of your eyes. It's because of theta. So theta equation is very very important. So with this equation only, even the exchange brokers and everyone are calculating how much your money is going to burn based on the time decay. So if the expiry is near, if your contract is out of the money, it's going to burn, your money is going to burn. So that will be like calculated by theta. Okay, so theta is very very important equation. So we are going to see each and every one by one. And next one is vega. So vega is nothing but it's going to find out the volatility. It's going to find out the volatility inside the market and how much it's going to change, and with that we can take the next step. So for that, vega is going to be helpful. Like even like whatever we just discussing and whatever we are going to discuss after this, everything has been implemented in the day-to-day life. Even this calculations are used to calculate the strike price, calculate the volatility, calculate the y, like everything, for each and everything these data are used. So the vega is nothing but it's going to find out the volatility. For example, if the volatility is more, how much the market can change. So for finding out the change which is going to be implied based on the volatility, you are going to use vega on that place. And next one is rho. Rho is nothing but the rate of interest. For example, you're just going to compare your portfolio with some risk-free interest you're going to get. For example, if you're investing your money on fixed deposit, you're just going to get a risk-free little bit like 3% or 4% interest. There is no risk. You're just going to compare that with your portfolio, whether your portfolio has the same risk or higher risk, or how much sensitive is there, and how much it's going to find out the change interest happen on the asset which we are just going to compare. So we are just going to compare with the free money which is going to flow with the riskier money. So with that, whatever you're going to get, it's like calculation you're going to do based on with the equation you can build a lot. And next one is charm. Charm is nothing but you're just going to find out the rate of change which is happening on the delta over a time. So like previously delta, gamma, everything is there, but charm is nothing but with the delta value, with the delta change, we are just going to find out with the time decay how much long, if the time decay has happened, the delta will change a lot. So for finding out that, charm is useful. And next one is Vana. Vana is nothing but you're just going to find out the different, like, between the delta to the the volatility which is happening inside the market. So with the delta, with the volatility, what kind of change can happen? So for that, Vana is has been used. And for Volga is nothing but the rate of change which is happened in Vega with the volatility. So you're just going to compare with this and you're just going to get some value which is nothing but the Volga. So mainly, we just use still Vana, Volga, like, like we will be using some rare case, but all this are used by exchange brokers, and the index funds or the options are using everything to find out what exactly is happening and how the strike price is moving, how the strike price is moving, and with that how the volatility is compared. Everything has been done by this.